brings us to every professor's favorite lesson in finance, capital asset pricing model. The capital asset pricing model is the way of determining the overall return on an asset based on three different components. The first component would be what we call the risk-free rate. This is the rate of return that you would expect from a perfect investment, which would be very low because it has very low risk. Then there would be what's called beta risk, which would be the risk associated with a specific, the risk of a company that would be associated with and always be in proportion to overall market risk. So in general, the market will value risk at a certain level, and the riskier it is, obviously, then the higher the rate is going to be. And that's called the beta. And then there's what's called stock-specific risk, and this would be the risk associated with a very specific stock. So the capital asset pricing model combines these three elements, the risk-free rate, beta, and the stock-specific risk, in order to arrive at what would be called an expected return. So the risk-free rate is usually based on 10-year U.S. Treasury bills, because this is what, that's as safe an investment as you could possibly get. So whatever return investors are pricing into the 10-year Treasuries, that would be what we call the risk-free rate. The market risk premium would be the difference between the expected market return and the expected risk-free rate. So it's shown here in the below formula as RM minus RF, because that's the additional return that you would expect from this particular investment. Market beta is sensitivity, this is great, much better than the way I put it, sensitivity of the asset's market returns to the overall market. So some stocks are riskier than others, so they move with the market, but they may move, most stocks move, well, not most stocks, but a lot of stocks are riskier than the rest of the market, and a lot of stocks are not as risky as the rest of the market. But overall, their risk level, their changes would be in proportion to the market overall, on average. So this would reflect the price stock volatility of the stock. And so market beta usually ranges from -1 to +1 or above 1. -1 is very unusual. So this would be a stock that moves in the opposite direction from the rest of the market. When the market goes up, this stock goes down. When the market goes down, this particular stock goes up. And this type of investment, again, is not your typical type of investment. If it's between 0 and 1, that is, if beta is between 0 and 1, that would mean that this stock is less risky than the market as a whole. And if it's greater than 1, then that would mean that this particular stock is riskier than the rest of the market. So let's take a situation where your market risk premium, that is either the market rate, that's the market rate minus the risk-free rate, is 4.6%. The beta is 0.56, which means it's a fairly low-risk investment, and the treasury rate is 5.2%. Then the expected return from that investment would be 7.8%, because you would expect 5.2% from an investment that had no risk. And then this risk premium here, which would be, in this case, 2.6%, coming from beta times the market risk rate, would give you an overall expected return of 7.8%. So you would expect to make 7.8% on this stock, on this particular stock. Now, these here are based on, these are what we call a single factor model, because beta is based on a single measure. But what you could potentially have is what are called multi-factor models, which is really beyond the scope of this class, but something to be aware of, where if you can identify different risk factors, you can assign each risk factor to a beta to each risk factor and get a more accurate measure of what the expected rate of return be. So these could be based on all different things. It doesn't have to just be the excess returns, but rather it could be things like operating leverage, financial leverage, industry membership, all sorts of different things. And then you could have a set of betas, and each beta would measure susceptibility to a different kind of risk. So multi-factor models can be developed that are much more accurate than the basic single-factor capital asset pricing model.